Alright, so in this video we'll continue on in our discussion of AUC sections 240 as it relates to our considerations of material misstatements due to fraud. And here we'll be taking a look at AUC section 240.25 through 27, and it discusses the identification and assessment of the risk of material misstatement due to fraud. So up until now in this section we have discussed gathering evidence about fraud. So for instance, inquiring with management and those charged with governance and obtaining other information to understand their fraud policies. But now we're going to use that information to try to identify and assess the risk that their financial statements are materially misstated due to fraud. And this is in conjunction with AUC section 315, and where the auditor should identify and assess the risk of material misstatement due to fraud at the financial statement level and at the assertion level, with the financial statement level being risks that are pervasive across all accounts, and then the assertion level being risks that are isolated to particular classes of transactions or account balances. So we need to take a look at the forest and a look at the trees as it relates to our risk of material misstatement due to fraud. And this assessment and identification should be ongoing throughout the audit following the initial assessment. So we have to assess this at the beginning of the audit during our planning process, and then also consider the things that we learn as we go through the audit all the way to the end. And they also specified that we need to consider and assess the risk of material misstatement due to fraud that would exist in revenue recognition. So then in every single audit that we do, we need to assume that there's a risk of fraud in revenue recognition. There are some cases where we don't have to presume that, but and that's explained in paragraph 46 and some of this explanatory material. But for now, let's just consider that whenever we're going into an audit, there's a significant risk of material misstatement due to fraud in revenue recognition, unless we can assume and document otherwise. And also, when we're assessing these risks of material misstatement due to fraud, we need to consider them as a significant risk. And a significant risk would be one that is more likely to cause a misstatement or that is higher than normal risk. And this term will be explained in future AUC sections that we go through. But for now, let's just understand that when we assess the risk of material misstatement due to fraud, we have to understand the entity's related controls around that risk. And we have to evaluate whether those controls are suitably designed and implemented to mitigate such fraud risk. So if we come to identify and assess a risk of material misstatement due to fraud, then we have to do a lot of extra work to understand that risk and to understand the controls that the entity has in place to mitigate that risk, because it's a very significant risk to us. So now let's go down to the explanatory material. We have sections A33 through 87, or 37 to go through, and we get some more color on how to go about identifying and assessing the risk of material misstatement due to fraud. All right, so now we're down in the explanatory material for some more information on identifying and assessing the risk of material misstatement due to fraud. First, we're going to be discussing the risk of fraud and revenue recognition. As we saw in the requirements, we're supposed to presume that there is a risk of fraud and revenue recognition unless we can document or understand differently. But the reason we have to do this is that material misstatement due to fraud and revenue financial reporting related to revenue recognition often results from an overstatement of revenues. So that would be like a premature revenue recognition or recording fictitious revenues, and that could result from an understatement of revenues through, for example, improperly shifting revenues to a later period. So given that this is such a high risk, that's why we have to single it out. And that's also why we need to understand the fraud triangle of different entities, because the risk of fraud and revenue recognition may be greater at some entities than others. For instance, some entities might have higher pressures or incentives on management to hit revenue numbers, for which they might commit fraud to report higher revenues. Also, for instance, if an entity collects a lot of its revenues through cash sales, there might be a bigger risk that of misappropriation of assets where the cash receipts are stolen or misappropriated. However, having said that, we can rebut the risk of fraud and revenue recognition. An example of that might be that there's a simple revenue transaction at the company, and an example of that might be leasehold revenue from a single unit of rental property. So we would be able to probably estimate about how much revenue they should receive if that unit is fully rented for the whole year. Therefore, it would be difficult for management to misappropriate or alter the financial reporting of that revenue without us seeing something unusual analytically. So that might be a situation where we wouldn't have to consider revenue recognition as a fraud risk and therefore as a significant risk, as we'll speak about here in just a second. So as we saw in the prior requirements, if we identify a risk of material misstatement due to fraud, we are supposed to characterize that as a significant risk and then understand the controls related to mitigating that risk that the company has. And that's what we'll talk about in these next couple of sections. So if we pretend that management has, or the company has, significant risk for material misstatements in certain places, they have the opportunity to close those risks, or at least mitigate those risks by implementing various controls. And they also have the flexibility to choose which controls they implement and which ones they don't, and which risks are important to them and which risks are not. And so in some situations, management might conclude that it's not cost effective for them to implement and maintain a particular control in relation to the reduction of risk and material misstatement due to fraud to be achieved. So in that case, they've decided that they don't want to take on the additional costs it would take to mitigate that risk, and that they're okay with that level of risk. And that's why it's important for us to obtain an understanding of the controls that management has designed, implement, and maintain to prevent and detect fraud. It's not really our place to say what controls should be put into place. We just need to understand what controls are put into place so we can understand where it might be a higher risk of material misstatement due to fraud for controls not being in place. So if we learn that management has consciously chosen to accept the risk associated with the lack of segregation of duties, then we know there's a higher risk in that part of the audit